Good morning, everyone. Welcome to week one of financial management. My name is Stephen Hilborn. I'll be leading you through the next 13 weeks. At this point now, I hope that you have been able to go through the syllabus as well as watch my introductory video that goes through the syllabus and the assignments and kind of gives you an idea of what this course is all about. This will be the first week's lecture. So what I'll do is two parts. So I will always have these videos posted a week in advance. So technically it's not week one right now. You will receive the week one lecture Monday, January 11th. And then the idea is that by time class starts the following week, you'll have watched the lecture and perhaps attempted the practice assignment. When our actual class starts, what will happen is that we won't go through the lecture. That will be up to you to watch and kind of get yourself up to date. What we'll do is we'll go through the practice assignment again, show you how whatever financial formula calculation that week we're working on, how it works, and as well answer any questions you may have. It could be an hour. We could spend all 3 hours. That's completely up to you. If you feel confident, if you feel like you understand everything completely, there's no requirement to come, although I do suggest at least every other week jumping in to make sure you understand what's happening. So I'll stop it here and I'll start the lecture. Bear with me. Some of these will be 20 minutes. Some of these will be an hour. It is finance. Sometimes it takes a while to wrap your head around. That's why I'm giving you the week in advance. So let's start. Okay. So first of all, welcome to financial management. A couple things that we'll be talking about, or our idea is that we want to be able to accomplish these learning outcomes. So the impact of changes in revenue and costs on net income. Prepare either comparative or common size income statements and balance sheets. Interpret the results of each major categories of ratios, stating how a creditor, an owner, an investor, or a manager may view these results. Calculate the annual revenue required for a hospitality organization to cover all of its costs, and then convert this revenue figure to multiple selling points. Calculate break-even points and target profit quantities, rooms sold, covers in a restaurant, and also prepare a statement of cash flow. Now, I know that was quick and I know that was a lot of information, but those are essential financial know-hows of just how to be successful in business. And generally that's what we need to know. So throughout this whole semester, I want to teach you how to run a business, how to look at the financials, how to read financials, and how to answer questions such as these. So where are my sales coming from? What is the average selling price of my rooms this week? What are my major expenses? How do I prepare and budget for a major expense? So let's say you have to do a renovation, you want to put in a pool, there was a fire or you want to just upgrade some rooms. What is our company worth? Can I sell it and make money? And when do I break even? So as a really good example, let's say you are a medium-sized hotel and you're wondering if you would be more profitable if you installed a pool and a spa. Now, before we look at the financials of that, you would have to say, okay, what's my competition out there? Does bringing in a pool and spa, is that something that my competitors don't have? So would that make me more attractive? What is the cost of all of these things? How would it affect my price point of what I would charge for the room? What additional labor would there be? So there's a lot of questions that you would have to ask. So additional costs such as labor, supplies, or energy, insurance, because now you have a pool where people could drown or hurt themselves. Does it change the style of guests that you would have? Can it bring in extra revenue? So you wouldn't typically charge a pool or spa fee. Most, like a pool as an example, comes with the room. The spa you might be able to charge per item, but how do you work that revenue into your room fee? How do we measure the success or the difference? What upfront cost would this be? And if it didn't work, excuse me, if we installed the pool and no one really came, what is our contingency plan? So there's a lot of questions you have to ask yourself and how to approach a question like this. So before we go too into the finances of a question like this, we have to think about the 5 branches of accounting. So the first one, and that's the one that we're working with, is financial accounting. So that's the recording of financial statements to show and measure the success of a business. We use 2 major equations to determine this. And we've all seen this before in our accounting courses. Revenue minus expenses equals profit. Now this will be shown on an income statement. Assets minus liabilities. Assets are the things that we own. Liabilities are the debts or the bills, so things that we owe. And what is left over at the end of it all. So this would be shown on a balance sheet. It is the year-to-year revenues minus expenses equals profit or loss that will affect our balance sheet. So the income statement affects the balance sheet. Another one is cost accounting. So cost accountants specialize in the analysis of the cost of the business. It is a little bit more detailed than financial accounting. They look at the specific costs and then therefore can determine a proper pricing model, such as on a golf course, how much do you need to charge for a green fee? So they would have to look at all the costs, all the labor, all the water that's required, all the renovations, the soil, the sand, the grass seed, all that stuff, and really come together with an idea of, hey, I expect to sell 1,000 tee times throughout the year. How much do I need to charge in order to post a revenue? And the next 3 are ones that we won't really deal with. So first, the third one is tax accounting. So this is just the proper and timely filling out of required documents with government associations. It is not something that we typically would take care of. We would hire an accountant for that. Same thing with auditing. So this is ensuring that we're complying by all legal requirements. And then the 5th one is the managerial accounting. So this is not as high level, and more so it's the day-to-day operations. So ordering, pricing, scheduling, hiring, these are all the day-to-day managerial accountants would have to work with. So we also work with what's called a cash versus accrual accounting. So there are 2 different methods of accounting, cash and accrual. The reason that we look at this and how and when we recognize sales, revenue, and expenses. So for a cash basis, we look at it so sales revenue's inflow is when cash is received. If I pay for my meal or I pay for my accommodation a week in advance, they record that as sales revenue right then and there as soon as I get a payment. Operating expenses is when cash outflow is when the cash is paid out. Now, 99% of companies work on the accrual basis, and so will we. So the accrual basis is sales revenue is considered earned or is considered to be true when it's earned. So as an example, it doesn't matter that you pay for your hotel room a week in advance. Me, as the hotel, will not write down that I've earned that money until you have been there and completed your stay. Same with operating expenses. The expenses outflow is when they are incurred, not when they are paid. Again, this whole semester, these lectures will be mostly introductory to a lot of different financial ideas. To start getting your head wrapped around the finances of a hospitality specific company. If I go too fast, if it doesn't make sense to you, this is when you bring up those questions in our weekly classes or email me. You will have the PowerPoints available to you at any time. So the next part is the 4 financial statements. So these are what we're going to read throughout this whole course. First one is the balance sheet. It's also known as a statement of financial position, and it just lets you know the financial position at any given time. So on March 1st, 2021, how much money is in the bank, how much debt do we owe, and if we were to sell our business today, how much would it be worth? The income statement is also known as a profit and loss statement. So this reports financial positions in terms of net profit. So did I make money or lose money over a specific period of time? Mostly it's month, sometimes it's quarterly. even in a restaurant or accommodation, we look at weekly. So what are our weekly covers? What are our weekly stays? How much money are we bringing in? The next one is cash flow statement. So it's a little bit different than an income statement. So income statement shows when you are getting money and how well do you do over a period of time. But cash flows, we pay cash out at different times than when we earn it necessarily. So I like to think of when you're paying your employees. You don't pay your employees every single day they come to work for you. Rather, what you do is that you pay them 2 weeks generally after they have completed 40 hours a week or 80 hours over the 2 weeks. So this is cash flow statement where on that one day, you're going to be paying a lot of money for 2 weeks worth of labor. So ensuring that you have enough money in the bank is pretty important. So we look at cash flow statements to ensure the ins and outs of our money. And then the last one is the statement of retained earnings. So also known as the statement of changes in equity. Equity is worth, the worth of your company. This is a statement of the worth of your company. So what they're saying is it details the movement in owner's equity, which is the worth, the value of your company over the year, let's say. So the income statement will show you if we have had a profit. If that profit is in cash, then it goes on to the balance sheet and increases our cash account. And then the statement of retained earnings will show that our company is now worth a little bit more than it was the year before because we had that profit. So they all work together, all four of these. So we'll go into a little bit closer look. This one here is your balance sheet. So your balance sheet is broken down into a couple different categories. You have your non-current assets. So these are considered long-term. They're not easily sold. Property, plant, and equipment, not easy to sell and get your cash out of. Intangible assets, which could be patents and logos and branding and things that have worth, but you can't really sell. And then current assets are ones that are easily converted to cash, or they are considered liquid assets. So current assets, you see here, it's inventories, trade receivables, cash and cash equivalents. These are all things that if I need to get hold of some money, I could sell my inventory fairly quickly and be able to get my $12,000 out of. Intangible assets are considered something that has no material substance, but has worth. So your reputation. So the Trump reputation right now was maybe one day worth a lot of money, is probably still worth some money to certain demographics out there, but it's also probably not worth that much to the majority of the world. Apple is a huge leading brand in the world, one of the largest companies in the world, and their brand, their logo, their reputation has value considered to it. Equity is what the business owes to the owners. So this is what the total equity is of this company. So if I'm an owner of this company, technically I have a company worth $165,000. And it is all of the assets minus all of the liabilities, and that is what I'm left with. Share capital represents the amount invested by the ownership. So how much do the owners have to invest into this company? And this could be one person, it could be many, many different people. Retained earnings is the total of the income statement and can be a net profit or loss. And this is how the income statement and then the balance sheet affect each other. And the next part of the balance sheet is liabilities. So these are things that you owe. So typically they are mixed between current and long-term. Current are things that we owe within 1 year of incurring that debt. Long-term liabilities may be things that take many years to pay off, such as mortgages or car loans or student loans. Trades and other payables are typically amounts owed to the company that have purchased something on credit. So I might work with a food supplier, I buy all my food on credit, and then at the end of the month, I pay them one time only. So the general purposes in this, a balance sheet is you can assess the risks. You can help identify trends in spending. So where does my money go? And also this will help you with receiving further financing and applying for loans or credit. When you go for your next home or your first home, what you'll do is you will show them a balance sheet, and they'll take a look at that balance sheet as well as your income and decide if you meet the criteria to get a certain amount of money. So income statement, it's a little bit more simple than a balance sheet, or can be. It's also one of the most important business statements out there. So as stated before, it deals with three different things: revenues, expenses, and net income. As you can see here, this is for a small a small landscaping company. And basically what they're doing is that they're showing their revenue here in landscaping, their total revenues, their expenses that they may have, and then again with their net income. This also shows on the right-hand side a percentage. So they have 100% of their revenue is $20,175, and that you can see what their costs are. But also on the right-hand side, you can see as a percentage of total revenue. So $2,200 is 10.9% of $20,000. Basically what this says is that 10% of all the money they make goes to paying for their auto expense. And almost 30% of all the money they make goes to paying commissions and fees. And 3% is for dues, and 1.24% is for insurance. This is the total of all of their different expenses. Which leaves them with $11,125, or 55.14% of their revenue. So for every dollar they make, they keep 55 cents. That's a good way of looking at an income statement there. And like I said before, this is some of the generic formulas for income statements. And they're made up of a few things. So first of all, it's revenue. So this could be from a single source, or it could be from many sources. And if you think of a hotel, they would have rooms revenue, food and beverage, catering, events, room service, activities, rentals, all kinds of stuff. The cost of sales is the cost of completing the work or sale. For sale of an item, it would be the cost of the inventory as well as production and labor cost. So in a restaurant, as an example, you might have all of your food revenue or your dining room revenue, but from that you would have cost of sales, which is the food that you actually spent or bought, and then also the labor it took to cook and serve that food as well. So the revenue is then subtracted by the cost of sales, which leaves you with a gross profit. So gross profit is the first income line. Basically what it means is that I've already deducted all of the cost of sales from that revenue, so what am I left over with? Here it's showing $55,000. So the next part is the other costs. So these are typically administrative or business costs on a greater scale. So administrative expenses, so this could be human resources, finance charges, which means that you have a loan out there and you need to pay your monthly or yearly amount on that loan. Distribution costs, these are all different things that could affect the business, but doesn't necessarily belong to any of those revenue areas, right? My human resources, they pay and work for everybody in the whole company. So it doesn't go in the rooms against the rooms revenue, or doesn't go against food and beverage. It kind of goes against just the company as a whole. Same thing with like a marketing cost. You don't market just the dining room, you market the whole property. So therefore it would be taken away after gross profit. So these are all the different charges. Comes out with about $15,000. The profit before tax is $40,000. They are taxed, and then they have a net profit of $28,000. I go more into detail of all of these. Just read these on your own. What are the other different expenses? We'll take a look at a lot of different income statements, so don't worry too much about that right now. General purpose of income statements is to identify the changes in sales revenue, help compare growth. So again, if you take a look at accommodation, how many rooms do you sell in January versus do you sell in July or August in the middle of summer? So here in Ontario, we sell a lot more in the summertime. It's just a nicer time. It's summer, it's warm. Generally, that's a peak season for us. in and around the holidays, but then you'll see slower seasons in January, February, and March, and then also in November, October a bit. It also will show changes in gross profit and net profit. So this is how am I working within my business. So gross profit will show me my cost of sales. So have my costs gone up or have they shrunk? Management affects those kind of things a lot. And then also be used compared to other competitors. So a McDonald's can compare themselves to a Burger King, to a Wendy's, and they see, okay, what are our costs of sales? Mine are 50%. Well, McDonald's only has 40%. So how are they saving 10% more? And they must be operating their businesses differently. They have a better supplier. They're cutting costs somewhere. So being able to compare to others is very useful. This is just a group income statement for the Intercontinental Hotel Group. So this is Holiday Inn, the Crown Plaza, the Regent, the Intercontinental. There's many, they almost have 1 million rooms. And it just gives you an idea of all of the different costs and all the things that take away from those costs. Now it's important to understand it can get quite complicated. We'll be looking at more basic income statements, but as you progress in this field, as your finance skills increase, we can start looking at a little bit more detailed stuff. Next one is a statement of change in equity. So we went through the income statement, we went through the balance sheet. Now, learning is all about having time to reflect on the material. So because this is a video, please feel free to take a pause, take a walk, go have a coffee. I am talking fairly quickly over this stuff, but I do want to be able to get this video out under an hour or 45 minutes. So you ensure you get all the information, but again, listen to it as you need. If you need to take that break, if you need to take a walk around your room or go get the mail, do that and then come back. Okay, so statement of changes in equity. So this is basically saying, okay, I've had a full year of operations on my income statement. It shows that I have made a certain amount of money. That will affect my balance sheet. The statement of changes in equity is what will tell your income statement will tell your statement of changes in equity how to change your balance sheet. So, hey, we've done well, we've made $10,000 more. We're going to add that on to our asset side of our balance sheet. So there's a couple different names for these. If you are a sole proprietorship, which means there's just one owner, it's statement of changes in owner's equity. You are the owner. For a partnership, which is 2 or more, it's a partner's equity. And then for a corporation, which many companies are, that means that shares have been sold. So you have a share is like a piece of the pie. It's a piece of the company. So people have bought many shares. So it's a statement of changes in shareholders' equity because the shareholders are the owners. So it's the most basic of statements, as this is only showing owner's investment, net income, and owner's withdrawals. So these are often used for smaller businesses, but it would look very similar to this. So they can say, okay, at the December 31st, 2017, we were worth nothing. We added our own investment of $10,000. We had a net income of $180, which is $10,180. We deducted $100 for our own personal use. That leaves our owner's equity at December 31st, 2018, positive $10,080. This can be negative as well, right? So it doesn't really matter, positive or negative. It just matters that you show it and then also how it would affect your financials. So this is a little bit more intense looking one. So this is a statement of shareholders' equity for the year ending December 31st, 2019. So they're showing their stocks, their common stocks, they're paid in excess of par. These are how a lot of companies fund themselves. So when a company sells a stock, it is a portion of a company. Now, how big of a portion? That's up to how many stocks are out there, how many stocks are issued, they call it. For ease sake, let's say there's 100. So if you have 100 shares that are out there, if I own one of them, I own 1% of the company. If I own 15 of the 100, I own 15% of the company. Investors typically purchase stocks with the hope of the value increasing or dividends being distributed. So often people say, hey, if I only bought Apple shares 20 years ago, I'd be a millionaire. And yes, you probably would. People buy these because they believe in the company, they think they're going to do well. And if I buy one stock today and it's worth $1, and in 10 years, it might be worth $25. So if I bought a lot of them, I could make a lot of money. So that's the idea. They also pay out dividends, which I'll talk about in a minute. Common stock is the amount set by the company for the value of their shares, and then paid in capital in excess of par. So there's the difference between these two. So common stock is the amount that the company has set for the value of their shares. Doesn't mean what people are willing to pay for them. That's market value. Just like houses. So you might look at a house and they will say this house, was worth $300,000, but because people want it, it's going to go for $500,000. That's market value. Right now, PlayStation 5s and Xbox, they think they're worth $700 or $800, but people are paying $1,200. That would be the paid in capital in excess of par. So the amount paid by investors for the market value of stock. The difference between common stock par and market value. So you see it right here, the common stock, $20,000, the paid in excess, or $20 million, $25 million. So basically what they're saying here is that their stock has more than doubled in value. Let's go to the next slide. So retained earnings. $11 million. So if you are an owner of a company, technically, let's say you own 15% of the company, you should be available to receive 15% of their net profit. At the end of the year, as an owner, 15% should go to you. Now, that is not always true because companies also need to spend money to get bigger. So if you are an Apple, now Apple has more retained earnings than any other company, billions of dollars in retained earnings, which if you are an Apple owner, so you own some of their shares, you might say, hey, why do you have all this money? Why don't you pay it out to all of the people who have bought your stock? And Apple says, I'm going to hold on to this because I have a new iPhone coming out. I want to build new Apple stores. I want to put new Apple commercials and marketing out there. And this all costs a lot of money. So I'm going to take some of this income that we've all made together. I'm going to spend a bunch. And that's going to be a cost to all of us. So instead of me paying out exactly every dollar that I've earned to all my ownership and then asking for it later, instead I'm just going to hold on to it for now. So in very layman's terms, that is what retained earnings. They hold on to it for future use. A treasury stock this shows the company has repurchased some of their own stock. So if they had some extra money left, but they don't see any attractive investments, they may purchase their own stock back from people. Again, you don't need to understand this after this particular lesson, but start looking at these terms and looking at these diagrams and these financial statements and start wrapping your head around some of this information. A cash dividend is a portion of the corporation's earnings to the owner. So you see cash dividends right here. So they paid out $1.5 million to ownership. So if you owned a portion of the stock, you would get a portion of that money. Stock dividends is instead of giving them cash, they gave the stock or the owners of the company more shares of the company. So basically saying, hey, I owned 15% before. Instead of giving me cash, which I would probably prefer, instead I'm going to keep that cash because I want to spend it on something. But here's another 5% of my company. It's most often that you don't see stock dividends, but instead cash dividends happen very often. And this here is showing you a Cineplex stock. So this is last year on January 3rd. So we're about a year later. So right now it's worth 34 in January 3rd, 2019, 2020 technically. It was worth $34.02. So this is what the Cineplex stock was worth. And this will give you an idea of the up and down of all of the worth and what's happening. So at some points it was down to $24 per share. It went up to 34. Currently today, I think it's around $9. And it was as low as $4 at some points during the COVID recession. It's important to understand what a stock is. So if I owned one of these, let's just say I bought it at $24.95. So I bought it for $30. If it goes up to 34, I have now earned $4 for every one that I own. So that's great. You know, I've earned some money. It's fantastic. Or I should say I've earned $9 for every one that I own. This can also dip and you can lose money. So my investment at $25, if I held on to it today, closer to worth $10, I would lose $15 for every share that I own. Couple things that you want to see here. It'll tell you what the previous close was. So yesterday it closed at $33.90. It since then has gone up 12 cents, which is under 0.5%. It tells you the day's range, so the flexibility or the fluctuations in its price. The 52-week range, so it was as low as $22 at one point, and the highest it ever was $34.39. How many shares are out there? So 732,000 shares are out there. And then it also tells you a dividend rate. So we don't need to go into all of these, price versus earnings ratio, but we will later on in the course. This one is a dividend. So again, this is a reward or a bonus for owning the stock. Dividends are paid out saying, thank you for owning it. Here's some money as a bonus. So they paid $1.80 per share, which is 5.31% of its price. So every 3 months, typically they would give you that 5%. And the next one that they said that they would pay it out on December 30th. Anyways, gives you a little idea of what a stock ticker looks like. And then you can go into a lot of different information here as far as historical data and profile and financials. We will get to all of that in future classes. So that is essentially the first week of learning. Basically what we want to take a look at is the 4 different financial statements and how they impact a business. We will be using these over the next couple weeks. So again, if you're a little feeling like that was information overload, do not worry, we will work with it more. I'd like to now open up the practice assignment. So our first practice assignment and what will be required of you in the actual assignments is a income statement exercise. So right here we're using Excel for this, and this is an income statement exercise which we will require you to find the numbers for revenues and also the percentage of total revenue. So I'll start it off, maybe I'll zoom in so it's a bit easier for everyone. Okay. So first things first, what we're going to look at is this sample income statement. Now we're looking for you to place all of the different revenues in here. Now because Excel is just so easy, what I will be doing is I'll be pressing the equal sign, and I can just go over and click on this particular cell and then press enter. So basically when I click on this, it says equals E5, and E5 is this number right here. So I'll just go through and do all these real quickly. So food revenue is this one. Beverage revenue is this one. Telecommunications revenue is $18,785. And other. Now, there's no reason that you can't just type this in, but it's easier to do it this way. And what am I missing here? Rental revenue. Rental revenue, I see none. So I'll just put 0. That's a no. I'll put 0. There we go. So that is essentially all the different revenue forms. Let's double check. No. So now what we're going to do is we're going to find our total revenue. Now in Excel, we can do a couple things. You can use a calculator and just add all those up and put the number in, but that's a bit wasteful as far as time goes. We can press the equal sign and click on each of the individual cells and then press the plus sign and just add all of these up. Okay, so you see I just said I clicked on B5, put the plus sign, B6 plus B7, so on, press enter, and it tells you what the total number is. If you are adding a lot of different numbers and they're all in a row and in a list right above you, you can also do equals the sum, S-U-M, an open bracket, and you can see here it's saying number 1, number 2, ... It's looking for a range of numbers. So I can click and drag right there, and now it says B5 colon B10, which is saying I want you to add up the sum of everything from B5 all the way down to B10, and enter. Something with 5 or 6 numbers, you can just add them up individually. It's not that much work, but once you start looking at 30 or 40 different things you need to add up, that's going to save you a lot of time. So that's your total revenue right there. Next, what I'm going to do is the percentage of total revenue. So now I want to know rooms revenue. Yes, it brings in $1.365 million, but what is that as a percentage of total revenue? So I will go equal sign the rooms revenue number divided by total revenue. Now, right now it says 0.667, which means 66.70%. This right here is not formatted correctly yet for you. So you can see up here, it's right now as general, but I know all of these are going to be percentages. So if I go through here and just click on the percentage button, it'll format them all as percentage. And then an important thing to note is that you always want 2 decimals with your percentages. So add 2 decimals, and this button here will add them and take them away. So 2 decimals. Now I know that 66.71% of my revenue comes from my rooms revenue. And so I'll do the same thing moving forward. Now there's an easier way of doing this. So instead of typing these all in individually, I can click and drag this particular formula. So if I wanted to, I can go on this, go down to the bottom right, and I'm going to click and drag. Now before I let this button go, I'm going to let you know that I know it's going to come up with an error, and I'm going to show you why. So it's going to come up as an error. It doesn't know what you're talking about. Okay, so if I look into the formula, B5 divided by B11. If I go down to the next one, it says B6 divided by B12. And this one I'm sure is B7 divided by B13. And so on and so on. So it's dividing these right numbers, but I want them all divided by B11. It's assuming I want to move, which I do not. So what you can do is that if I put a $ in front of B and a $ in front of the 11, basically I'm saying to this, I'm going to copy and paste this formula, and I want the B to remain the same and the 11 to remain the same. So now when I click and drag this, it now does all the correct math for me. So you can see these, all of these individual ones. B11 has stayed, but that's B8, that's B9, that's B10, and that's B11. So that's a very quick introduction to this income statement practice assignment. Basically what we're doing here is looking at all of the dollar amounts and then looking at percentages. We always make decisions based on percentages, not the dollar amounts. So when I say, okay, my beverage revenue is 10.54% of all of the revenue that I bring in. And then next year I take a look at it and it's gone up to 12%. As an owner or a manager, now it's my responsibility to say, okay, did we make more money in that department or did we make less money in others? If we made more money in that department, then what were we doing right? What were we doing wrong? How can I use this to my benefit? These are the important things to start asking it after we've developed these numbers and figured that out. I sure hope I'm recording. Yeah. Okay, so I'm not going to do the rest, but I want you to do this on your own and before class, and then we will also do it with each other during our actual class time. All of the numbers are up here. Go through, figure this all out, and at the end I want you to find out how much money do we have left, and everything is a percentage of total revenue. You'll have to do some calculations on your own, you'll have to do some formatting on your own, but it'll be great for you to do that. Okay, so I'm not going to save that. All right, so other than that, I will see you on either Monday or Wednesday during our class. I hope you're all having a great time so far. If you are scared of math, that's okay, that's sanity. If you need help, I will help you, but please watch all the videos before the class starts. Try the practice assignment, it will be loaded up in weekly learning on Blackboard, and then when we do finally join together, we can go over it one more time or answer any of those questions you might have. But for now, I bid you adieu.